Good afternoon, everyone, and thank you for joining us for today's webinar, learning about the new retirement plan for tax credits available, presented by Rain Associates. My name is McEwan, and I'll be moderating today's session. Before we get started, there are a few housekeeping items to cover. If you have any questions during today's presentation, you may enter them into the chat box on your screen, and we will try to answer as many questions as possible at the conclusion of today's presentation. However, to be respectful of your time, we know that we may not be able to get to all of them, so therefore, after today's webinar, we'll review all the questions and get answers sent out to you via email. You can also access a copy of today's presentation in the handout section on your screen, and we'll also be sending a copy of that after today's presentation. Today's webinar will be given by Paul McEwan. Paul is a CPA and principal at Rain Associates. He leads the firm's retirement plan consulting and administrative services team. He oversees our retirement plan consulting services on plan design, compliance, governmental reporting, and fiduciary best practices. And I'll pass this over to you, Paul.
All right, thank you very much, Becky. Good morning, good afternoon, I guess now, everybody. Thanks for taking a little bit of time out of your lunch. I think we'll keep this to about a half an hour today. And for some of you, you might figure out pretty quickly this isn't going to be applicable for you, and you won't offend anybody if you decide to jump off and go enjoy lunch somewhere else with somebody else, and that's certainly fine, and probably the best use of your time. So what we wanted to accomplish today, Becky, if you can go to the next slide, please. What I wanted to accomplish today was really just to kind of introduce this new retirement plan tax credit. And it's really hard to describe when we send out emails and invitations to these webcasts because it sounds like it might be kind of a new tax credit for participating in a plan, but this is exactly the way it sounds. It's a tax credit for retirement, for brand new retirement plans. So for employers that have never sponsored plans before. So if you've got a plan, so that's one of the things that I wanted to go through first with everybody, was just kind of set the context for the tax credit and how they work and what organizations will be eligible and can take advantage of these perhaps. So these tax credits, new tax credits, came out of Secure 2.0, and that was a massive piece of legislation. One of the provisions was these new tax credits, and Congress really had the goal of coverage, expanding coverage, particularly for very small employers, and they define those as fewer than 100 and in some cases fewer than 50 employees, and really targeted these new credits to those small employers. So one of the big barriers to very small employers sponsoring plans is just the administrative cost and the cost of making contributions on behalf of employees. So these credits directly address those initial costs, concerns of small employers. Now, eventually, these credits phase out, and the employer will have to figure out how they're going to budget these costs and continue the plan. But Congress was thinking if they could at least get the employer kind of over that initial concern of the cost of the plan, especially the first few years of a startup plan, they can be a little more expensive administratively to get going. Once the plan starts to accumulate some assets, the plan can actually begin to pay for a lot of the expenses itself and take that burden off of the employer. But initially, when you're starting a plan that has no assets in it, a lot of those costs kind of fall on the back of the employer. And so that's what these credits are really designed to address. So specifically, the credits were meant for defined contribution plans only. So these don't apply to solo 401k plans. You have to have non-highly compensated employees covered, which basically means non-owners have to be a part of these plans in order to take advantage of the credits. The cash balance plan or defined benefit, the old traditional defined benefit plan, they don't count. What Congress is really focused on is trying to create opportunities for employees to save on their own in a retirement plan. And those defined benefit types of plans are employer funded only. They don't allow for employee contributions, so they're not covered by the tax credit. So those two categories of plans are specifically not covered. I mentioned before, it's small employers only, so fewer than 100 employees. If you're from a large organization, this isn't going to be much of a benefit to you either. And these credits are funded through tax credits. So if you're not a tax-paying organization, if you're a nonprofit or a governmental entity, you're not paying taxes, there's going to be no way for the government to subsidize the cost of a new plan for you. So these credits are not a great solution for employers in the nonprofit space or the governmental space. So really, we're still looking at a big, a fairly wide group of employers in the country on the for-profit side, but because we're funding through tax credits, there's no mechanism for getting money back to the employer if you don't pay taxes. Next thing I want to talk about real quickly is these credits are, as you will see, we're going to walk through some calculations, some fairly simplistic calculations, but what you're going to figure out pretty quickly is these credits are pretty complicated to calculate, and you need a lot of employee census information to do the calculations. And so I would tell you for the advisor partners that are on the call that we partner with, helping plan sponsors together, tell your clients to lean into the relationships they have with their TPAs. If that's Ray and Associates, they can lean into us. If it's a bundled arrangement, they'll need to kind of lean into their record keeper to help provide this information. But CPAs who normally take care of tax credits and the calculation of the credits that show up on tax returns, business tax returns, they're not going to be in the best position to do these calculations. And I think the industry is still wrestling a little bit with how are we going to help clients, plan sponsors through these calculations come the end of this year. First, identifying the ones that are eligible. We want to make sure we don't miss anybody. Because at Ray and Associates, we've got a lot of clients that maybe they're working with people that, other than Ray and Associates on their plan. And we need to be reaching out to our clients and making sure we understand everything that they're doing from a plan perspective, from a business perspective, so that all of that activity, if there is some tax credits available, they take advantage of that. But even if we do find that out, if we're not doing the TPA work, we're going to have to ask for that information, because you'll see that particularly on the contribution credit side, you need to really kind of go through employee by employee to calculate the amount of the credit. So that's just a heads up that if you normally rely on your CPA to do the tax credit calculation for this credit in particular, I think you're going to be better served to reach out to the TPA or the record keeper. I will be sending out a one-page summary also at the conclusion of the presentation today that just goes through all of the credits, the administrative cost credit, the contribution credit, and the enrollment credit, which we'll talk about here in just a second. So the last comment I have is, I don't think these credits are a game changer. All the great reasons for sponsoring plans, whether it's recruiting employees, retaining employees, rewarding employees, financial wellness of your employees, all of those great reasons for sponsoring a retirement plan in your workplace are there. This just gives another gentle nudge for those employers that have kind of been sitting on the sidelines, really concerned about the initial costs of starting one of these plans, and saying, hey, we'll take care of that for you for the first few years, get you used to the costs, maybe get the plan going, and maybe the plan can carry some of the costs on its own, so it's less expensive going forward. But it's just another gentle nudge. So in my opinion, not a game changer, but certainly if you can take advantage of these credits, you absolutely should. All right, so we're going to go through, we're going to review the tax credits. Box 1, box 2 is the advantages of the qualified plans. So we're going to do a little bit of discussion about plan design and some of the nuances about how these credits can impact the decision on your plan design for those that don't have plans yet. And certainly as a TPA, we're well positioned to help with that conversation also. And then in box 3, we'll cover just really quickly the Savers credit expansion. That doesn't really come into play until 2027. So just a couple quick slides on that, and just a heads up that that's coming down the pike. So next slide, please, Becky. You're running ahead of me. That's great. Okay. So as I mentioned before, we have tax credits in 3 buckets. We have startup costs, we have employer contributions, and we have automatic enrollment. And so we'll kind of go through each one of those in turn. So next slide, please. You can keep on going. So we'll start with the startup credits. The credit, so this is pretty much, this credit existed before Secure 2.0, but it was a smaller credit. So the great news of Secure 2.0 is that this credit got increased to, at least for employers with fewer than 50 employees, up to 100% of administrative costs. So before 2023, all employers with up to 100 employees could get a tax credit of up to 50% of the costs associated with the plan for the first 3 years. And that was great, but Secure 2.0 made it even better by increasing the tax credit, at least for those employers with 50 or fewer. You still get the 50% credit if you're between 50 and 100, but if you have fewer than 50, now you get a full 100% credit on those costs. So now for 2023 and beyond, employers with up to 50 employees can receive 100% tax credit for the first 3 years. Keep in mind that admin expenses include the TPA fees. I alluded to the TPA before. So any fees that we would charge, billable costs directly to the plan sponsor, those would be considered startup costs. Any investment advisor fees that an investment advisor might charge because it's a brand new plan and there are no assets in the plan. Some advisors will have an out-of-pocket, or not an out-of-pocket, but a billable fee to the plan sponsor, maybe in the first couple of years until there are some assets in the plan. Those would all be considered startup costs of the plan. And then certainly any record keeping, any billable expenses from the record keeper would be considered startup costs of the plan. And then for those plan sponsors that are considering adopting a multiple employer plan or a PEP or some sort of pooled arrangement, we did get guidance that in terms of when the plan starts, it's the adoption of the plan by the plan sponsor, by the adopting plan sponsor, by the employer, that starts the clock ticking on when, is it a new plan or not the initial start date of the multiple employer plan. So like the multiple employer plan might have started in 2019 or 2015, doesn't matter, several years ago, but the employer is now just opting into that multiple employer plan. They would be eligible for any out-of-pocket startup costs. So I just want to cover that real quick. Next slide, please. So let's just take a look at a quick example here. The company has 20 employees, all of whom are eligible for the plan, 2 highly compensated employees and 18 non-highly compensated employees. The company's going to adopt a plan for the first time, and the expected expenses are $2,500 for the first year and $1,500 for years 2 and 3, and that's pretty typical for the advisory. The advisors on the call today probably would agree that's pretty typical. There's usually more expenses in the first year, and then it kind of levels out after that. Before Secure 2.0 is passed, the company would have been eligible for a tax credit of only 50% of the amount, up to $4,500 each year, bringing the total cost of the company from $5,500 to $2,750 for the first 3 years. Now with Secure 2.0, And the new credit, the employer can take a credit equal to 100% of expenses up to $4,500 each year, bringing the net cost of the company to zero. So I think that's what Congress had in mind for most small employer plans, was that hopefully the credit takes care of most, if not all, of the out-of-pocket expenses. Now, I think it's important to explain to plan sponsors or potential plan sponsors that the credits are going to come at the end of the year, right? So they're going to have to cash flow and pay those costs up front, but then they're going to get the benefit of those credits when they file their tax return in 2024. So there'll be a little bit of a tax flow or a cash flow issue, but probably worth explaining that just so that there are no surprises from the plan sponsor's perspective. Next slide, please. So the second tax credit we're going to take a look at is brand new as part of 2.0, and that's the tax credit for the employer contributions. And so I don't ever remember, I'm sure there was a case, but I don't remember a time when the government actually subsidized or paid for a credit. I mean, they give a deduction for employer contributions, but to have a credit for actually making a dollar for dollar credit for making employer contributions is pretty phenomenal. And that's what we've got here with this potential credit. So this new tax credit allows employers who have no more than 100 employees to take a tax credit for the first 5 years the plan's in existence. The tax credit's equal to a certain percentage of the contribution that's provided to each employee who makes less than 100,000 in FICA wages. So that's important. So the Congress was really targeting rank and file employees and wanted to make sure that they weren't subsidizing plans that were sponsored just by highly compensated employees. Now, they didn't use the dollar amount that corresponds with highly compensated. I don't have any idea where they came up with 100,000. That must have just sounded reasonable, or maybe it was, the amount that worked in the budget in terms of the overall legislation. So for the first 2 years, the year the plan was adopted and the next tax year, the employer can take a credit equal to 100% of the employer contribution up to $1,000 per employee. And then the percentage phases out over the next few years. So in the next year would be the second year after adoption or the third year of the credit. The employer can take a credit of 75% of the employer contribution up to $1,000. That's important. Then the percentage drops to 50% and then 25% in the next the final 2 years. So the government is providing a big incentive to get employers to provide employer contributions and then easing them into kind of bearing the costs, as I mentioned before. This is available for all employers who have up to 100 employees, but the credit's phased out for employers who have more than 50. And the way the phase out works is for every employee that you have over that 50, there's a 2% phase out, so that by the time you get to 100, the credit is completely phased out. Interestingly, where the startup cost tax credit was completely unavailable to a company that maintained another plan in the 3 years before the current plan is adopted, this tax credit is available to that employer. The company simply loses 1 year of the tax credit. So for example, a company who currently sponsors a simple IRA can end that arrangement, adopt a 401k now, and receive up to 4 years of tax credits. So there's a real incentive for companies to consider a plan now, even if they've been using an IRA type of program. Next slide, please, Becky. I think you might have gotten them. See, I'm on slide 10, Becky. There we go. So let's take a look at how this credit might work in practice. So in this example, we have a corporation that has one owner making more than 100,000 and 5 employees who all make less than 100,000. The employer provides 10,000 in employer contributions between those 5 employees in the amount shown. So let's first look at employee 2. This employee is getting $750 from the company. So in year 0 or the year of adoption, and the next year the company gets a $750 tax credit, which is 100% of the contribution. In the next year, the tax credit becomes $562.50 or 75% of the $750, and then $375, which is 50%, and then $187.50, which is 25%. However, the tax credit doesn't always trail down that way. So let's take a look at employee 1. This employee is getting a higher contribution from the company, $5,000, which makes a difference. So the tax credit in the first 2 years is $1,000, which is 100% of the contribution, again, capped at that $1,000. But in the next 3 years, the credit stays at $1,000 because 75, 50, and 25% of 5,000 are all over 1,000. So you can begin to see some of the complexity that's going on here and why the CPA firm or the tax preparer may not be the best entity to be calculating these taxes, or if they are, they're going to need a lot of information. Information, frankly, that the TPA or the record keeper already has in all likelihood. So the employee generates the maximum $1,000 tax credit every year. So in this example, the cost of providing employer contributions is cut nearly in half and is substantially reduced in all years, which if you're a small employer can be very significant. There's nothing preventing the owner from receiving a tax credit on his or her own contributions. So if the owner makes less than $100,000, or if it's a partnership, an LLC taxes a partnership, or a sole proprietor, regardless of how much the owner makes, because the owner doesn't have FICA wages. Remember, we defined, that 100,000 as FICA wages, and none of those types of tax entities, the owners don't pay themselves FICA wages. It's self-employment earnings. Therefore, they can't exceed the $100,000 threshold, and the owners would be eligible. There'd be nothing to prevent the owners from taking the credit for their own contributions. Next slide, please, Becky. All right, so just a couple quick slides on automatic contributions. This is nothing new. This was part of Secure 1.0, but because Secure 2.0 makes automatic contribution a requirement for all newly sponsored plans after December of last year, this is going to start to come into play more and more. So I think we just need to kind of retrain how we think about these things. And not forget about this. It's an easy $500, not a lot of money, but it's a dollar for dollar reduction of your taxes. So if you're eligible for it, there's no reason not to take advantage of it. Again, not new. And again, if the company has up to 100 employees, if they implement an automatic enrollment plan, which they're now required to do under Secure 2.0, and that company can take a $500 tax credit for the first 3 years that the plan offers the auto enrollment feature. The Secure Act requirement for automatic enrollment is a particular type of EACA, and therefore generally all, like I said, all new plans going forward that have this auto enrollment feature are going to be eligible for this credit. Next slide, please. So now that we've talked about kind of the types of tax credits and how they're calculated, let's put this in some real context now with how this all plays out and impacts a business owner's decision kind of regarding the type of retirement plan they want to offer. And I would say to our investment advisor partners on the call today, this is a great opportunity for us to, as TPAs, to help add value to the relationship. And this is when you're having that plan design illustration discussion, it would be good to also talk about the potential for and the impact of these tax credits on the plan design. So let's kind of run through that. So we're going to take a look at the business owner's bottom line, but But first, we're going to look at, and most of the advisors on the call today are familiar with plans, so I'm not going to spend a lot of time on this. But the key takeaway here is that the tax code creates a clear trade-off between tax savings opportunities and simplicity when it comes to plan design. So obviously the deferral IRA is the simplest option, no 5,500, no testing, but it has the lowest deferral limit and obviously offers no tax credits. On the other end of the spectrum is your 401k plan. That requires a 5,500 in testing, but offers loads of flexibility in who is covered, what contributions are offered, whether those are vested, and it generates tax credits. And then kind of in the middle, you've got the simple 401k or the simple IRA, which has limited reporting and testing, but in turn has more limited flexibility, requiring full vesting, requiring certain coverage, mandating contributions, and offering lower deferral limits. So that's kind of the middle of the road option. Next slide, Becky. These plans change a little bit beginning in 2024. So we add in the starter 401k, and the rules are tweaked a little bit on the simple 401ks. The simple plans will be permitted to have slightly higher contributions, but the other trade-offs regarding flexibility and simplicity are obviously still there. There will also be a new option for companies just trying to offer an initial deferral opportunity. And frankly, I think in Ohio, these starter 401ks are not going to get a lot of traction. We haven't seen a lot of clients asking about them, don't have a lot of investment advisors talking about them. Not much of an advantage in Ohio. In Ohio, we don't have state mandated IRAs, where I expect to see starter 401ks utilized more frequently is in New York, Colorado, Illinois, California, where they've got state mandated IRA programs, and employers may not want the government option when it comes to the state mandated IRAs. And obviously there's no opportunity for plan design or employer contributions or anything of the sort when it comes to those state mandated IRA programs. So again, I think what Congress was thinking was this would be kind of an easy on-ramp, if you will, for employers that have never sponsored a plan before. Here's something really simple that they can get started. It's deferral only, no opportunity for employer contributions, but it allows that accumulation of assets into a plan trust, so that at some point when the employer is a little bit larger, a little bit more sophisticated, and wants to begin to add an employer contribution, they'll have some plan assets that they can go to market with and begin to maybe get a little bit better deal from a record keeper when it comes to a more complicated, more sophisticated plan design. So I think that's really all I wanted to cover on that slide, Becky. So now that we've kind of looked at the types of plans, let's see how these different types actually impact the owner's bottom line. So in this example, we're just comparing a deduction-only IRA to a 401k plan. So let's first assume that the cost of the two arrangements is the same. I don't know if that's a good assumption or not. That might be a little bit bold. But that, for the sake of argument, that's kind of what we're showing here. So in that case, the business owner takes the IRA expense as a deduction, which results in $97,500 of earnings, all of which is taxable, leaving the owner with $77,025 in earnings after tax. On the other hand, the $2,500, excuse me, in the plan situation is taken as a tax credit, so it's not deductible. So instead, the company treats the entire $100,000 bottom line as taxable, but then reduces the taxes owed by the tax credit. So here the company gets a 50% startup credit. So there's a $1,250 tax credit, leaving the owners with $77,750 or $725 more than the IRA option. So really just kind of, that's just showing the power of the tax credit versus the tax deduction. So pretty simplistic. Assume that the cost was the same. We know the IRA is likely cheaper because there's less administration. So we did a little break-even analysis. We see that the IRA would need to be nearly $1,000 less expensive for the IRA to be equivalent. So we're just kind of showing why it might pay with the tax credits, pay to do something more than the tax deductible IRA plan. Next slide, please, Becky. So the comparison becomes even more potent when you're looking at 100% startup credit. In that case, the 401k becomes even more valuable, leaving the business owner with $79,000 as compared to $77,025. So what's the break-even point here? Well, the IRA would have to be free for the net earnings to be the same. So we know that's not possible. So that the tax credits will always make a plan a better deal when you're just comparing it to the IRA option. So again, we're focused on small employers that have never really thought about doing a plan before. So that's kind of why we're going through this analysis and comparing it to an IRA. So it's a different perspective in the very small plan market. Next next slide, please, Becky. Thank you. A couple behind me there. One more. There we go. So now the prior examples took a very simplistic look at the plan to help illustrate the value of a tax credit over reduction, but the business owner's bottom line is more complex than that, just because the tax savings opportunities in the plan also differ. So in this example, we'll add in consideration about how much the owner is getting from the plan. So like before, we look at how the business owner's tax liability is impacted, but we also should consider how much benefit the owner is getting from the arrangement. So earnings less taxes owed plus the amount the owner is saved in the plan is truly the amount the owner is retaining for his or her own benefit. So looking at the deduction only IRA, just as before, the cost of the arrangement is a deductible expense, brings the net earnings figure in the example to 111,785, and then we add back the owner's deferrals to the IRA because they're retaining that benefit. Brings us to 117,785, and how much of the 150,000 the owner actually is retaining for his or her own benefit. Now let's compare that to the 401k. Here we're assuming the cost is the same for the moment, but the owner defers 20,500. It's actually 22,500 is the limit for 23, but this example uses the old limit to the 401k rather than the 6,000. So the increased deferrals impacts the amount of tax the owner pays. The owner's net earnings are 102,805 after the tax credits, but she also has 20,500 in the 401k, so she retained a total of 123,305. So the higher deferral limits. So for this audience, probably a pretty simple, and you get kind of understand how the math works. And this has kind of been the power of qualified plans all along. Now we're just kind of creating some additional incentive, as I said before, with these tax credits. So then the break-even analysis is kind of over there on the right-hand side. You'll see that it ends up being negative in terms of the deductible expenses. And then, Becky, if you go to the next slide, you'll see that we can actually decrease the deferrals down to 14,145, and you end up, to make the kind of the take home, the net retained benefit by the owner the same between the two plans. So I don't know how powerful this is, but I think just kind of showing how the real dollars and cents flow and how plan design makes a difference when you consider the tax credits and the tax deductions related to both. Next slide, please. So in the case of the 401k, it gets even better when you start to consider the business owner who wants to get to the 415 limit. So here we're showing the idea that in a full-blown defined contribution plan, you have the ability to do large non-elective employer contributions up to 66,000. And this illustration just kind of shows you kind of how powerful that can be. And this is a conversation that we go through many times a year with prospective plan sponsors, just kind of showing them what the possibilities are and talking with them about how much can they afford to put into the plan for themselves and for their employees, and what do the plan demographics look like. And I don't really want to belabor this slide for this audience because I think you guys really understand this really well. This was an important slide, I think, yesterday when I was going through this for our own CPAs at Reyes, as he's trying to educate them about this new tax credit. But this audience really understands kind of the power of the tax deductions and qualified plans, and it's one of the last best tax shelters out there. Next slide, please. So just a real couple, we'll finish up with the Savers credit. Again, this doesn't come about until 2027. There's an existing Savers credit right now. It's based on the participants' AGI, and they're fairly low. So I would say most of us probably aren't working with participants. Well, you have participants in plans that this may apply to, but you may not be working with them directly. The income thresholds and the match percentages are shown on the table. It's helpful for some, but there are a few significant hurdles. Number one, many participants in the category don't have the tax liability, so their income is so low that they don't have a tax liability, and therefore they can't take advantage of the tax credit. Number two, the participant needs to know that it exists and file the long form 1040 just to claim the credit. So I think Congress was concerned that a lot of folks that might otherwise be eligible for the Savers credit were missing out. So they tweaked it as they are wont to do so often. And they turned it into what they're calling a Savers match that doesn't start until 2027, because frankly, I don't think we'll have the connectivity and the technology and the database connectivity to do this until then. The industry will start working on it as quickly as we can, but essentially Secure 2.0 changes this from a traditional non-refundable tax credit to a matching contribution. Rather than a tax credit, the federal government will actually match 50% of the first 2,000 of an eligible employee's contributions to a plan. Again, kind of a mind-blowing concept for me. But that match generally, it's going to have to be deposited directly into the retirement plan or the IRA. So that's why I think we just don't have the infrastructure in place to be able to do this right now, which is why 2027 was put out there as the potential effective date. I'm not holding my breath in terms of this becoming effective in 27. Could be a lot of changes to it before then. It might go away, but I just wanted to kind of give everybody a heads up that this was another way that Congress was trying to get more people covered, more dollars into retirement plans to kind of address the retirement savings crisis in the country. Next slide, please, Becky. I think one more, please. Sorry if I lost you, that's my fault. So this chart simply compares the current credit versus the new Savers match. Interestingly, it's not a better benefit for all participants, particularly for married participants. However, it may still be a significant increase in incentive for many. You could use that as an additional reason to participate in the plan. So that's what Congress had in mind. So with that, we're at about 12:40. Becky, that was all of my prepared slides, prepared remarks. Do we have any questions from the group? This is a pretty informed group when it comes to retirement plans, so they may or may not have lots of questions. I don't know.
Thank you, Paul. No, we don't have any questions at this time, but know that just for all that are attending, we will be sending, like I said, the recording and the presentation to everyone, and Paul's information, contact information will be included. So if you have questions later on or after reviewing the material again, please feel free to reach out to him directly. He's happy to answer any questions you may have.
I am, and my partner Steve Renner is also happy to work with any advisor, any plan sponsor, try and figure out the impact of these tax credits, eligibility, whatever it is. So Very good. Thank you, Becky. Thank you, everybody, for joining. Have a great
Take care,
day.
everyone. Bye-bye.